All right. Also, in top
What is
terms of
up,
other
everyone?
assets, real estate, alternative investments, gold, okay, private equity, commodities, art, okay, all of these things
Art
count.
sounds good.
Then, guys, check your
Art
net
sounds
worth
really
at
good.
least one time a year, but please don't do it every single month or every single week because it becomes a nerve wreck if you are looking at that number too much, especially with the fluctuation of the market. One thing that helped me along the way was being a guy that's disciplined, I'm patient, I'm never hasty. And so, when it comes to me, I don't get knocked off my square when the market is down. I'm looking at that as an opportunity. That's how you get really, really wealthy when the market is down because you can buy low. You can get great assets for lower prices. Over here, we call that blood in the streets. And when it's blood in the streets, it's time to eat. Okay. But when you are thinking about the value of your assets and then you are looking at your net worth, you have to know, yeah, I'm mindful of the number, but I won't get overly hung up on that. Okay. It will fluctuate, especially the more money you acquire, the more money you get. But you need to know it. You need to know, are you at a negative net worth? Are you at flat line at zero, which is a good thing? Or are you above zero? Okay. That is the goal. And then as you get those different milestones achieved, you want to then make sure your net worth is trending in the upward direction. Know your net worth, okay? Number six is the big three, okay? Housing, transportation, and food. You already know, guys, I've spoke on this hundreds and hundreds of times. Don't have more money in your driveway than you do your brokerage account. Do you live
That's a
in
good
a,
one.
a high cost area where if you made some adjustments, you can get your rent knocked down by $1,000, by $500 just by moving 50 miles north or changing locations? Okay, housing, transportation, and food are very, very key in terms of either helping propel you to debt freedom and getting off the corporate plantation or keeping you bound. Okay, it keeps you in
Excuse me.
bondage to not being able to do all that you want to do because, like, man, food is so high. I spend $300 a month on food. Okay, well, where you live at, it might be costing that much, but maybe instead of going to the high end store, maybe you go to Audi, maybe you go to Dollar General, maybe you try some different options and alternatives. Okay, matter of fact, let me know what you guys do for finding cheaper food options. Okay, transportation. Do you ride public transportation or do you drive yourself? Okay, these are decisions that you want to make on a wealth building journey. All right, and then of course housing. If the rent is high where you stay, you may want to consider just making one simple change. Although it might be a big change, it might be significant in terms of reducing how much money is being shelled out for something you don't even own. Okay, and then guys, number seven, renegotiate your bills. Renegotiate things you are paying or things you are paying down, and see at the end of the year, going into the new year, is there a new promotion on your subscription for your cable or your TV or your cell phone or anything else that you might indulge in on a regular basis. If you can renegotiate your mortgage or things that you have, again, maybe got credit for, but now you saying, you know what, I rented this yacht, let me try to see if I could get my payments reduced. You want to renegotiate at the end of every year going into the new year because you might can get lower rates which again saves you money. Okay, and then number eight, tax-free money opportunities. Once again, the HSA, you want to take advantage of all of these things. The Roth IRA, okay, you want to take advantage of charitable giving. You want to take advantage of anything that can reduce your taxable income and make sure that you are taking advantage of those opportunities that actually exist. Start a business. If you have business expenses, these things help. Okay, and then last but not least, guys, set your 2026 financial goals and make sure you have a clear plan and strategy for how you're going to achieve those goals. I always say start with something that gives you an easy win, whether that's you got $500 remaining on a credit card, pay that off and allow that to snowball into propelling you to pay off or down the next thing that's in line. Maybe that next credit card is $1,500 balance. Okay. And then now you're chipping away at that slowly but surely. Then you might have something that's $15,000. And now that becomes the focus once you got the 500 and the 1,500 out the way. Set your 2026 financial goals. Know what you want to achieve. Know how much you want to make. Know what you want to pay off. Make it a game because it's a marathon, okay? But as always, run your race at your pace, okay? This is a game of fortitude, and those that are built for the fight will come out on top. I can guarantee you that. Listen, guys, hopefully these 9 things is helpful. Hopefully you are prepared, locked, loaded, and ready to go for 2026, because around here it's going to be a joyous ride. All right. With that being said, we make videos like this every day. So if you like this one, make sure you check out the next one. Remember, most people see the end result. Very few consider the journey. Do me a favor. Don't forget to subscribe to the channel. Make sure you guys grab some free stocks using my link below. And I'll catch you guys in the next one.
Peace. All right. That was good stuff.
See a melt up in that as well. Whenever a company has a board meeting on how to implement AI and they start spending on that implementation, where does the money flow? It flows into these businesses. And so while the company's AI investment may or may not pan out, well, all that money is still flowing into these companies. Now, you also have to think about the Fed angle. This week, we have a Fed meeting and a decision on rates. And when they look at the economic data, here's what they're seeing. They're looking at the economy of December 2025, and their data shows that consumer sentiment is low. It's the lowest since the 2022 inflation panic. They see that the average American continues to get punished by inflation that has remained sticky. They see that the labor market is cooling. We're in a low hire, low fire freeze. Entry-level jobs have been destroyed. Inflation year...
Okay. All right. Jeez. Let's jump into a little breakdown on TSM and CoreWeave. If you're on YouTube, you can drop a comment and that'll show up here. And I guess it'll show up from X too, but I just want you to go over to YouTube. That's better. Okay. God damn it. Only show TSM numbers in USD. CoreWeave, 100% year-over-year growth in revenue. We have a cloud platform. I don't really get it. So they're not buying the data centers. Microsoft and Meta and OpenAI and IBM. $1,000 into these 2 stocks can surpass your full-time job. I'm not a financial advisor, but Taiwan Semiconductor, ticker symbol TSM, has been grinding up day after day. It shows no sign of stopping at a time when a lot of other semi names had little bounces. NVIDIA had a nice bounce, but then it came back down. So TSM seems to be grinding up That's evidence of sustained buying. Company does a lot, $33 billion in revenue in Q3. So institution can't buy all the TSM they want in one day. So it takes day after day. So what we can do is we can hop on that trend and we'll look at the chart to see what I'm talking about. There's another company, CoreWeave, ticker symbol CRWV, has partnerships with Meta, Microsoft, OpenAI, IBM, 100% revenue growth year over year. They provide the GPU compute layer. So they're not making GPUs. They're not using GPUs per se for AI answers like ChatGPT is. They're sort of in the middle where they connect it all and make it a usable platform for AI engineers, AI researchers, the people who build the software that we know and love, like ChatGPT. The company is CoreWeave. They have a lot of capital expenditures. They take on a lot of debt, but they seem to be perking up as well. So let's look at these two stocks right now.
This is Sam Putnam.
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 All right, so this is TSM, and this is that grinding activity I'm talking about. If we look at this buy here, we had a big move. It's unusual to hang up here after a move. We did give back a little the last couple of days, but we're still up 5% just about from the very bottom lows here. So pretty awesome. Maybe in anticipation of the rate cut, the FOMC meeting is tomorrow, Wednesday, December 10th. So it's not always a great idea to anticipate, what's going to happen, but you're basically making a bet on what people don't know about what's going to happen. And I don't think you know, and I don't know anything that other people don't know about this rate cut. So I think the chance is like written as 85% or something on the Fed website. We can look at that, but this is not a, macro magician channel. We're trying to pick individual stocks, because if we knew how to pick, which way the market would go, we would just look at that every day. I don't know anyone who does that consistently, or even relatively profitably. What people are good at is looking at individual stocks that seem to be setting up at a time when, other semi stocks, Nvidia, sure, it had a nice little bounce, but it sold right off. It's still choppy. So you can look at other semi stocks in this sector. Here's an ETF to look at. It's not SHM at all, actually. It's SMH. And it's grinding up, but when you look at the individual companies that make that up, AMD is kind of like a wedge, which these never really seem to go. If you look at ONDS, a recent wedge, it's holding in there, but it's only interesting once it really builds out a flag. And once you look at a chart like this, it's like, great, you bought it here, or you bought it here, you stop out. You bought it here, you stop out. So what's preferred is a clean flag. Frog is one company that did break out. We talked about on this channel recently. So that's great. They don't always work, but what it does is it provides you very small risk to make a big move the upside direction. Or if not a clean flag, then what you kind of want to look for is some type of earnings pivot opportunity, high volume close here, a move up with, above an earnings level. A more obvious one would be something like Guardian Health, which did move up 25%, coming back a little bit. All these sort of pharma names, PPH is the pharma ETF selling off, the healthcare ETF XLV selling off a little bit. Energy is doing okay. If we look at some of the energy names, PARR selling off some, Dyno selling off some. ZOM is the one to look at for, you know, the sector as a whole. It's one of the bigger ones, Exxon and Chevron, and they're fine. I mean, Chevron's not fine, but if you were looking at ZOM, it's fine. It's holding in there. It could go in about a week or so, but none of these look like they're going to go, you know, tomorrow. And if you look at some of these, Devon Energy, still building out a flag, not sure how exciting that is. TAL gave back some, and New Era actually sold off Next Era. So energy's not exactly shaping up how it could have shaped up. Pharmaceuticals and medical companies, not as exciting as they might have been. MedP selling off, and you know, some of these smaller biotechs are still hanging in there, but you do have that risk of a Unicure or an IntelliTherapeutics where they can just give it all back. And when I say give it all back, I really mean give it all back. So you got to be careful with that. And Meta bounce was working, came back a little bit. Amazon coming back a little bit. These big tech names are, you know, always worth looking at. A little higher low for Microsoft, but not something that's shaping up right now necessarily. Google had a shape up here, had a flag shaping up here. You know, it's close to having another one, but at some point, you know, you just have to wait. And Tesla, unsurprisingly, a little bit of a pullback, you know, a couple days ago with all of this resistance here. So hopefully we can build something out here and then have a move to the upside, but it's not there yet. And then the robotics names as well, holding in here, RR and Serve, some higher lows, some moves recently on that little, well, it's not little, we'll see if it comes out, executive order rumor. iRobot, the low price one. PDYN didn't really do anything soon, and BBAI also in that AI robotics category. The executive order was for robotics, and previously there had been an executive order for drones. So unusual machines, you know, which is having a little bit of a bounce here, but not super interesting. RCAT as well in that category of former speculation names that pulled back a lot, sort of holding up. And the main one, of course, Ondas, ONDS, shaping up the best. So those are in the conversation. They did have an executive order for drones back in April. So the executive orders definitely matter. But at the same time, you do want to look at sentiment. And rare earth sentiment did have a little bit of a jump. USAR, MP materials probably looking the best, but still going sideways. So all of these names that were speculation names, the quantum names, little bounces as well. They're all in the conversation, but you just have to pick the ones that have higher lows, in my opinion, rather than that are just going sideways. So for that reason, people have been looking at, you know, this Bitcoin miner turned data center compute. So Iron is one of the laggards, and it's still holding in there. You see it does not have a higher low. But if you look at a company like Cypher, this has been really interesting. Building up this flag here, we'll see if it just keeps, you know, having these tight days, which give risk to reward opportunities that are favorable. Of course, it's difficult if you do buy the breakout and then you have to stop out, but, you know, maybe you get chopped out a couple times, you know, lose $1 a share each time, a couple dollars a share, and then suddenly you get that, you know, $5, $6, $7 a share or more. So those names are definitely shaping up. The AI compute names, Wolf, one of the stronger ones as well. TeraWolf. Mar and Riot were the original Bitcoin miners. Those ones haven't really had much buying interest. Core is also in the conversation related to CoreWeave, actually. Finally seeing some upwards motion after that sell-off when they had that vote saying they were not going to be acquired by CoreWeave. So CoreWeave, the namesake of this video, is having a little bit of a bounce and holding here. So what it's doing right now is offering a pretty favorable spot over this 89.2. So you risk 5 cents, look for $5 up to 95, and that $100 psychological level. It sold off significantly. The earnings were better than expected on that earnings per share, but still a loss. So we can take a look at that. TSM as well, earnings sold off a little bit, even though they actually beat. And all these companies that are big, and again, TSM with 30 billions of revenue, sold off over the past month because the market sold off. They are the market. TSM is, again, Taiwan Semi, not to be confused with Tower Semi, which has been shaping up pretty awesomely, actually. And speaking of names that have done something like this, the networking names are doing pretty well. AAOI had a move, as well as Coherent, which has been staying up here, light up as well. The ones that haven't gone yet that are interesting to keep an eye on is Lumentum, which sold off a little bit. This is a pretty big move. It doesn't look like it. That's 20%. So keep an eye on those. And then the memory names as well showing strength. So Mu coming up to a favorable level. SanDisk still being trouble for shorts. It had this incredible move. It's not surprising people might have shorted in here. And then Western Digital as well as Seagate holding in there super well. Someone had rumored that Sam Altman had bought not all of, but a ton of memory, and without, near-term plans to use it or actual use of it. So who knows if that's true, but they certainly are acting like there's been a ton of demand. I don't think out of all these names you necessarily want to look at these right now. I do think something that's shaping up to a level. So for TSM, this level right here is important, 309 and then 317 this high. So if you find a spot to get in, that's great. Over a high, that's even closer. 304, so you buy at 305, risk 304.50. Risk 50 cents, maybe $1 to get $10. This could totally go up to 315. So you can sell out half and then trail the rest on, say, a 5-day moving average, like this pink line. I guess you could say that's not pink. That might be salmon or whatever. And, maybe it comes back. You have to sell out, but maybe it holds and you're able to get 10, 15%. So that's the idea with TSM. CoreWeave, similar idea as far as trailing with that pink line. Or if it really goes, you can wait for this blue line, a 10-day smooth, simple, S stands for simple, moving average, which is going to be a little slower. So on the upside, over here, it's kind of the idea is you say you bought here and you sell out half with a 10% move to the upside. The blue line doesn't catch up until here. Maybe you have to sell out the other half or up here. So on average, your sells are up here and you got like 20, 25%, which is a pretty big move on a $500,000 account. Using a 10% position, 25% would be a quarter of 50,000, which is 12.5K, which is a solid gain for that account undeniably. So those are two ideas. And then as far as big picture stuff, gold is holding in here sideways. Silver, kind of similar. It had a little bit crazier of a run today and then forming the shelf. So you can look at AG for that. I don't know how many people caught this. The silver names themselves weren't that interesting. It was really just the futures, which is not really what we focus on or that you would be ready to play. The gold ETF, looks like all these other ones. GFI or KGC is the biggest gold miner. They're mainly South Africa based, NEMAEM. So Ashanti, I don't know if any of these are that interesting right now. And then we talked about energy a little bit, oil selling off. That's not that interesting either. So bouncing around the market, there's not a ton of super exciting activity. I know this was sort of a whirlwind tour rather than a deep dive on CoreWeave or on TSM. But frankly, CoreWeave has been a little bit choppy in the past. This was annoying here. And so shaping up with you're going to want a tight leash on this because they do have a lot of debt. And when companies have a lot of debt, they can make highly leveraged moves. 300%. I mean, this is an IPO move, so it's not totally related to the debt, but same idea. And then TSM coming up to important level is the idea there. So nothing super fundamental there. Those are two ideas. If you like those, hit that like button. You'll get more. And if you want a free course on how to find the next NVIDIA without gambling on startups, hit that subscribe. I'll post that in the YouTube posts once a month. If you want to join the Discord, try that trial out. You'll see those testimonials. Head over to stockscommunity.com.
Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
Cool.
Over year is still above target, 3% versus the Fed's 2% goal. They see the GDP is positive, but it's largely being carried by AI investment. Remember, CapEx is a key component of the GDP calculation. So the Fed's going to put all this together, and what are they going to see? They're going to see an economy that's holding on by threads, propped up by corporate AI spending that could easily fall apart if the Fed decides to go a little bit more hawkish than expected. So the decision they're facing right now is, do we fight that last 1% of inflation, or do we stop what's left of the labor market from completely collapsing? I think they're going to focus on the latter, which means what? Well, a lot of opportunities for melting up. I understand there's a lot of doomsday content out there. People like to doom scroll. People have been waiting for the next massive crash since the dot-com bubble, since 2008. A lot of people think 2020 wasn't enough. They think 2022 wasn't enough. They want a massive crash that goes down 90%. Otherwise, they're staying all cash. I understand that's what the media preaches. However, if you're a doomsday person, you should understand that we are heading for doomsday, but it's not the doomsday that causes the market to go down 90%.
Jeez. This is getting depressing. Okay. If you are on Twitter X, comments, the chat, all that will show up on the screen. Otherwise, you'll see this recording. Yeah, keep it locked. And we'll jump into Figma and Lemonade here. $190 million, up 40% year over year for Lemonade, and Figma $270 million, up 40%. So this one stock can change early buyers' lives. I'm not a financial advisor, but some financial advisors might say to buy as much as possible before December 13th. The company is Lemonade Insurance, ticker symbol LMND. It had $190 million of revenue in quarter three, up 40% year over year. It is an insurtech marketing automation company. So they put up ads, consumers go for a quote, and they get a cut of that. So they are unprofitable right now. But the company itself, the stock price, looks like it's shaping up very well. So this is sort of a momentum play rather than a long-term bet. You know, it's in the same category of like buying Open Door stock, which is, you know, whatever, $15 right now, and very unprofitable. So that's the first company. There is another company as well, Figma, which is a recent IPO. They do design software, kind of like Canva or like a new version of Photoshop. I think Photoshop or Adobe meets Google Docs, where you can collaborate and you see everyone's, you know, real-time changes on there. So they actually were going to be acquired by Adobe. There's a little bit of a trust issue there, and they have been IPOing and going down. So it looks like there could be some turning up recently. They recently had earnings, revenues up 40% year over year. I'm not even sure if they've been public for a year. We'll have to look at that, but I guess they just use their private numbers for that comparison. And they have a lot of revenue, 300 million. So this is, you know, no Microsoft Paint or anything. This is a big deal design tool. And these two companies are both software names. but under the guise of insurance and I guess AI. Figma has, AI as their, all these software names are AI names right now. So let's jump into these. The market is holding up into the Fed likely cut tomorrow. As of the time of recording this video, let's jump into these two.
This is Sam Putnam.
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 Who's burped? So the first company, Lemonade, revenue of 190 million, up 40% year over year. This is what we're seeing on the Lemonade chart. Sort of a picture perfect flag, which, not to say the same thing every time, but what's happening is, to say it in a dumb way, people wanted to buy it after earnings. They didn't want it that much, so they sold it. They definitely wanted it more than that. They didn't want it that much. They wanted it more than previously, and then they didn't want it again. So there's definitely a spot where there's uncertainty about it being worth more than that, but every time it comes down, it gets bought back up almost immediately. So think like quicker and quicker buyings of the dip. So the reason I say that in sort of like fifth grade way is that this is not astrology, right? I mean, it is if you're looking at a tiny name, but this company has millions, hundreds of millions in revenue. Recent earnings is a loss, but it beat expectation, and it's setting up well. And if you look at Figma, it's a little different, but same sort of idea where you can risk, I don't know, yesterday's open, 38, depending on where this, if it doesn't gap up. Ideally, it goes sideways, comes up, another green day, and then goes sideways again, and you can buy it right over 39. You can risk this high of 39.4 and risk 20 cents to make $2 at least, but more like $5. So that's kind of ideal. And just to make a picture of what I'm talking about here, basically, we would hope this would go sideways overnight. Maybe have one more up day, or you'd even have a down day and then an up day. But what you really want is not to have a gap up in the morning, because then you're buying it up here, already risking 1% or more, when you want to buy it as close as possible to your stop. So you can risk 0.25% to make, 2.5, 0.25% to make 2.5%, or, at worst 1% to make 10%. So it's not to make this totally mathy, but I'm just being real with you. That's pretty much how people who do really well with it. It's not like they necessarily know that these two companies are going to be the next, Cursor, the next Kalshi, the next OpenAI. I mean, I'm naming private companies, so that's a really bad examples, but the next NVIDIA, the next Taiwan Semi, the next AMD, the next Robinhood, those are all public companies. So what happens is maybe you buy it here, you get chopped out, but your loss is very tight. So someone who's extremely good might actually lose here, here, have 3 losses, and then the fourth time they buy it, even when it just goes up 5%, they've already paid off those 3 losses, and then they're holding it and they make, 30%, and now they paid for a bunch of other losses as well. So it's not really like, the best investors, I guess you really ought to be calling this trading, are seers or, future seekers or anything like that, fortune tellers. It's more like they're extremely risk averse, and they try a lot of different entries until they find one where they can just sit in it, stay positioned, and then just get paid as well as the company does the work, or the more demand comes into the stock. So could happen with Figma as well. Maybe it was interesting here as a little bounce play, got chopped out, you lose 1%. Maybe I don't know, maybe here, although it had already gone up 3 days, and then you lose 1%. You've already lost 2%, and then here you make 10%, and you've made 8% in aggregate. So there are commission fees, but they're pretty minor with almost all brokers. Of course, Robinhood doesn't have any commission fees at all. So I can look at what these companies are doing. I've talked about Lemonade in detail in the past, so not really enthused to do that. But this is what they do. If you're just learning about this company, they do AI for insurance. So, the voice of this company is basically being the middleman between insurance companies and social media companies, aka companies that sell ads or ad space. And then Figma, if you're not familiar with this company, they do user interfaces. It's a super cool tool, product development. They're in the same category of Notion. If you've come across that one, it's basically like a project management tool, like Asana, that will probably go public at some point as well. Figma is like the new Adobe. So I don't know why I'm navigating this website for you. It really doesn't do anything for you investing wise, but that's the actual company, and they are, branding themselves as an AI company as well. So Figma Make is the AI tool. So those are the two ideas that I think are super interesting, and can come up with idea. I sort of gave price levels already for both of them. And then as far as context of just the broader market, probably the smoothest way to look at this is if you just look at, you can have a watch list, that's great and all, but if you look at the companies that have moved the most recently, and NBIS is in that category, it's a company NVIDIA invested hundreds of millions in. How you measure these is you look at how much they've moved over the past week or 2 weeks, and then you look at how much they're moving over the past year on average. So this NBIS has moved 7% over the last 10 days. SanDisk has moved a lot too. Neither of those are particularly interesting. T10 is just up too much. I think it's also super illiquid and choppy. So these are how you find these stocks. We do talk about this in detail in the Discord, as well as how past ideas went. QXO, another example of a stock that, if you see on that screen, 33% is the average daily range over the past year. And how could that possibly be the case? Well, look at this move. It went from 13 to 24. So actually, no, this is why it had that move. So you can just completely ignore the stock entirely, actually. But soon, some of these AI stocks moving more than 5% a day are all in the ballpark of interesting. But in general, you don't really want to buy crypto stocks when Bitcoin is still struggling. So a lot of these companies are sort of out. Maybe you can risk something here and jump in. I know MicroStrategy, or Strategy as it's now called, is finally leveling out, so there's some buying interest there. But if you're just banking all on crypto right now, I don't really know that now is the time. Galaxy is turning up a little bit, Circle is turning up a little bit, but I certainly don't want to buy too much of these. BMNR, another one, the Ethereum Treasury, they're having moves, but as always, you kind of want to look for opportunities where flags have formed, and not at the bottom of bases, but somewhere where there's significant volatility contraction. So the flag gets tighter and tighter and tighter and then explodes up. And this is just beautiful. We've talked about this Bitcoin breakout multiple times. Tesla breakout, very similar. This is as beautiful as it gets. And these are the most liquid assets in the world. So until that happens, this is the Bitcoin ETF. IBIT is the way to play that, in a similar way to Tesla. It's just not that interesting here. I get that it's a higher low, but we were just looking at a lot of companies that had higher lows, and then selling off. Navitas, everyone's excited about this company because it had a 100% move, but unless there's some type of reason to buy it, which I don't see it really right now. I mean, sure, you can buy off of this level, but it's just there's better opportunities here. So it's good to sort of stay away from some of these story stocks. And if you look at these stocks the way I think makes the most sense of them, to look at them, it's smart, I think, to look at sectors. So a firm would go together with Upstart, right? They both do lending, buy now, pay later. Neither of them are particularly interesting, but banks as a whole are not super interesting. They've already gone up. Goldman Sachs has gone up. Interactive brokers is always kind of difficult to play. It's choppy. And in Morgan Stanley, these stocks are fine. They just move very slowly. So this is hard. This is all messed up on this chart. So if we look at Wells Fargo, also a little bit messed up. Well, regional banks, KRE, and that one is easier to look at. But in general, these banks, we looked at Goldman Sachs, that pretty much tells the story. Citi is another one that tells the story. They've already gone up, and they move really slowly, 2% a day. So there are some stocks that have done well, that move slowly, 3% a day. EQT could get interesting there. The most recent one, GEV, that had a big sort of move in one day. 5% in a day is huge when you're a company. It's whatever it is, $600 times 2 million. It trades over $1 billion a day. So there are definitely opportunities out there, but for 99% of people, they don't need that much liquidity in a day. So I don't even bother talking about it. Plus, you have to be aware that just because GEV went, that wasn't totally predictable given VST and some of these other power stocks. They're setting up, but PWR, Quantum, may or may not go. This company is a sort of a GPU services company as well. It's actually not a power stock. That was a terrible example. But GEV and other power generation stocks, definitely worth keeping on watch. This company previously, I've mentioned it multiple times on the channel. They are basically similar in the category of Bloom Energy, which is remote mobile energy services for data centers. So you can set that up really quickly. So long-term, interesting, but short-term, I don't know, just kind of choppy and not particularly buyable, kind of like A-Lab, interesting, but then you have big candles down like this. Marvel had a big sell-off as well. So the semi-play that's in the same category as A-Lab. So there's a lot of names, sectors that have been talked about by me, by others. Quantum is not interesting. Batteries are a little bit more. QuantumScape and AMPX almost as good, but EOS probably the best in terms of high or low and price holding up there. As far as these two ideas, though, looked through a lot of stocks here, and Lemonade is definitely the cleanest flag, and TSM probably the easiest risk-reward setups right now. So if you like these ideas, hit that like button. I know this is a lot, but every once in a while you got to just plow through the charts just like you actually do in reality instead of talking about the stories. And if you want a free course on how to find the next NVIDIA without gambling on startups, hit that subscribe. If you want to hang out in the Discord and see the best idea of the day, head over to stockscommunity.com.
Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
It's the doomsday that causes your purchasing power to go down massively, that causes the average middle class person to get destroyed while asset owners continue to get richer and richer and richer. And that's why we're coming on here so often and preaching the best stocks that we believe are buys to help yourself position appropriately. We're heading for the world where the rich are going to get far richer, and you need to appropriately position for that. Okay, so along those lines, what are the opportunities right now? Well, I've got 3 great stocks for you here. These are picks and shovels ideas in the AI economy. I believe each of these are going to be beasts in 2026, and I'll make my case for them. Okay, let's start with number 3, UiPath, ticker symbol PATH. Now, this is a stock we've been preaching all year, and a lot of people have kind of fuddy-duddied on it. However, what you saw this week was nothing short of confirmation of everything that we've ever said about this stock. This has been a stock that has long been trading very, very low and detached from its fundamentals, and we finally saw a beautiful pop after reporting earnings this week. And if you know earnings reactions, you know it could be 50-50 on whether their initial pump retains for any given time, but I'm not concerned about that. What I'm concerned.
All right. Path. UiPath. About these Urban Outfitters earnings. $1.5 billion, up 10% year over year. And Ulta is $2.9 billion, up a little over 10% year over year. 2.9 for Ulta and 1.5 for Urban Outfitters. So, if you got any comments, questions, drop those in the chat. We're going to sign off after this one. Let's get going. 2.9 for Ulta, 1.5 for Urban. There is one stock that is about to skyrocket. The company is a retail company. Ulta Beauty, ticker symbol ULTA, at over $2.5 billion in revenue, up 10% year over year. Another retail stock with 10% year over year revenue growth, over $1 billion in revenue. Urban Outfitters, ticker symbol URBN. So it turns out mainly women still want to shop, and a lot of these sales are coming online. However, for products that you want to try on, it's still interesting to go in and try those on. And it's not just Urban Outfitters and Ulta Beauty, not that you try on makeup, but I think this company does a lot of e-com sales. Kohl's as well had a big quarter, and Abercrombie and Fitch, ticker symbol ANF, and I guess it would be AEO, American Eagle, AEO is the ticker, also having solid earnings reactions. So it was a big quarter for retail. It's easy to say that's just because of Black Friday and future Christmas shopping. But it's not just about sales, it's about beating expectations, and expectations have been met. The reactions are strong, and these two tickers, Ulta and Urban, look to be shaping up the best with the best risk reward right now. Let's jump into these two stocks.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam
Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
All right, so this is Ulta Beauty, 2.9 billion sales, up 10%, a little more than that year over year. Same store sales increased as well, so they're not necessarily closing sales. It's interesting how same store is measured now. It's comparable stores, so it's per store plus e-commerce. So I think they must take the total e-commerce sales and then divide them by the number of stores. But somehow they figured out to have a solid margin and make money based on, it sounds like, charging more or getting the clothes for less. It's not really, or getting the makeup for less. It's not a idea particular to Ulta Beauty. I mean, if you look across, they actually opened 28 new stores. That's pretty incredible. Closed 15, but still. Look at these stock moves. I mean, Ulta's up a lot. Urban is up a lot as well. Kohl's is KSS, that's up a lot. And AEO, ANF, I mean, just across the board, retail earnings have been super solid. And it hasn't been followed by, good just consumer earnings. If you look at some of these food stocks, Eat and Shack, Dash is sort of related, but they do food delivery, so it's a little separate. But airlines, or actually these are cruise lines, so it's not quite the same. Not doing great. It's at the same time, the airlines have been doing a little bit better. So generally, at a time when, say, COVID, it was super obvious what's going to do what. I mean, airlines are going to not do well, right? Cruise lines are not going to do well until everything opens up and then they go up. But right now, it's a little bit of a mixed bag. I mean, airlines doing well, cruise lines not doing well, food not doing well in terms of fast food, basically. And then these retail stores doing really well. So I think it makes sense to look more within a sector rather than across what are sometimes correlated sectors. So I think retail is a good place to look. So here's how this stock is shaping up. You definitely see a flag forming here, and might go, might not, but the way to do it is to say, hey, I'm going to buy over 77.3. So hopefully this doesn't gap up, hopefully it goes sideways or down a little bit. And then risk, say this high, risk 77.3. So risk 25 cents to make $2.50 or a lot more. Maybe risk 50 cents to make $5, but that's Urban Outfitters. And then Ulta Beauty is a little different because, it just hasn't gone sideways as much. So you have this high volume close. You see all the volume. It's high, highest right here in the last year. And you can buy over that level of 600. It's super special, simple psychological level as well. So risk a couple dollars. It's at 602, assuming it goes sideways today, tomorrow, the next day, whenever you see this, and buy over that. Try to make $30 on a risk of $3 up to 630 or so. So super strong, and trailing off volume is completely normal for these companies. And if we can kind of take any lessons from other high volume close opportunities, KSS hasn't done it yet. You still have the same sort of opportunity here where 22.5 is a place to buy it over. So it's holding that right now. I mean, maybe the opportunity was today or yesterday, but there's 22.5. So it actually broke it here, but maybe tested it here, broke it went slightly below. But the idea here, right, is you buy somewhere in here, and maybe you hold through this. Maybe you're asleep at 9:30, you're at work, whatever. Sometimes you just very quick moves, you don't stop out. Maybe you throw in a stop, maybe you don't. I'm not going to jump into that too much. That's like the reality of trading and investing rather than the risk reward theory that we're talking about here. But it is what it is. Let's say you got in after this move down, and sometimes actually these move downs are in pre-market. Now this one was in regular hours, so it actually should have stopped you out. But if you do get in somewhere up here, 23.25, you're risking 75 cents to 22.5. So you really need to make $7.50 up to 30. And it's totally doable on this chart, looking at a 5-year chart to get to 30. We're just getting over the 200-day moving average. So that's kind of the risk reward you would be looking for on a stock like that. And again, to use this high volume close, just language a little better, Guardian Health, another example. Like there's going to be some rough days. So November 4th, for example, was a pretty rough day here in terms of, let's say you got in before that. That's going to be difficult because, it stops you out, except you probably don't have a stop in after hours anyway. So in reality, that's probably okay. But if you look at a 30-day chart, this is super trader talk now instead of talking about fundamentals, but I'm just trying to level with you here. If you go to 92 as your high volume close right after the earnings, and you can see how it held it pretty clearly here. If you buy here, you risk that level, maybe you risk $1, you just stick above that level, and you're in at 92 one of these days. You've made $6 so far, and then you just throw your stop in and you just remember 92. So far it's holding above that. I know it's been a month, but sometimes these stocks can take a month of sideways before they ultimately go. But when they go, they go. So for example, and I can get rid of some of these lines. I just leave them in the past. I don't want too many lines on your charts that other people don't have, but if you did buy on a high volume close, like, when it got over 350 for app, that's pretty obnoxious because you stopped out here. Maybe you get in again. Maybe you even get stopped out on this earnings. But what can happen, this is a better example, right, is you sit in a stock for a month and then finally you get a move up and maybe you get chopped out. Sometimes you have to be in a stock that doesn't go down right after earnings, Netflix being the most beautiful example probably from this year of a straight 40% move, which might not seem like a lot until you realize it's a $100 stock trading 50 million of volume. So we're talking $5 billion a day. So the reason we trade these big stocks, big market cap stocks that don't move as much, is you can get cleaner moves. So you can take tighter risk. And the reason the moves are cleaner is that institutions are accumulating over days because they have to take huge positions. They can't get into little stocks like TVTX, which is shaping up right now, or stocks like PARR, which was shaping up and then sold off a little bit. Another one could be NAMS. Some of these little biotech names that are sort of choppy and trade, $1 million, $40 million a day. Institutions, funds can't buy those, family offices even. And so they do look for these massive, the Spotifys of the world that have enough liquidity where they can get in over multiple days. Spotify is probably one of the worst examples of actual price action that followed this trend because it's so choppy. But Spotify has always been choppy. It's kind of in the AAOI category, where you might get a day up that's super exciting, but in general, this is not a stock you want to wrestle with. So past price action is indicative of future price action. Another stock in this optical category, CAHR, or even light is even smoother, are better examples of that. And here's a perfect example of, again, the earnings situation. If you buy after earnings, it might take, a few weeks until you get over that level. And, here's another earnings example, which has been challenging, but at least you have a clear level to buy over. So, it might break that level a couple times. You might get stopped out twice. This is the reality no one wants to talk about, is you might lose 1% on a 500K account, a 10% position, percent on that is only $500, but you lose $1,000 on this stock. How excited are you? Lose here, you lose here. How excited are you really to buy it after it goes above that level again here? Maybe not that excited, but you keep using that 50,000 position. Maybe your account's down a little bit, so you lost $1,000. Now it's a $49,000 position at this point. But eventually, you do get that 10% move. You trail half of that position. You sell here, or you just hold, and suddenly, on average, your cost basis gain, whatever, is 30%. So you've made 30% on 49 grand, 50 grand, call it, and suddenly you're up almost 10 grand, which totally cancels out that $1,000 of loss. So that's where the 33% win rate, proves its metal, it shows its colors, whatever. There are some metal names shaping up, actually. TMC looks pretty interesting right now, sort of a flag situation like Lemonade that I was looking at. It has this clear level over 8.2, and it's the same situation. I mean, we can look at the past to see what might happen here in the future, but if you see, these are kind of so quick flags that they're not good examples, but somewhere in here, let's say that you bought it here, this would have been pretty stupid to buy. Anytime something is just wedging up, I mean, that doesn't look that interesting, right? It actually looks a lot like some of these recent, NBIS names. There's a reason I'm not saying to buy NBIS right now. But anyway, I understand this explanation is very visual and I ought to be more fundamentally focused, but the reality is that the technicals are examples of what's actually happening on the chart, and the fundamentals are stories, right? Which do need to be told, but don't need to be dived into in detail. So anyway, let's say you lose 1% on TMC. In reality, on this stock that's 585, losing 1% is difficult, right? 58 cents is not very much. You might lose 2% on a stock like this because it just whipsaws so quickly. So you lose once here, you try again, you see a flag here, and maybe you somehow stop out here. Some of these wicks are pretty nasty. It moves 9% a day. So now you've lost 4% on this stock. But eventually, when you do buy, and you get it in a way where you don't get stopped out the next day, you can get that 50, 40% move, and suddenly losing 4% is nothing. So you literally can lose more than you win on an individual stock in terms of entries and still come out ahead. But those are just a bunch of flag examples. Flags are not the only way to buy these stocks. Another way is, lemonade is a flag, but if we look at some of these other companies, EOS is an example, what they also have done is come down and then formed higher lows. So you're buying over a base, sort of a base breakout. And if not EOS, another one that might be interesting, trying to think of levels here. Cipher is a good example where you had this level up here. It sort of went up here, came down like it's a peak on the left side, and the price went under that, it undercut it, and then went back above. So you can buy as it comes back above that peak or as it undercuts it, and that's another way to get 20-30%. So pretty innovative, different ways to buy these companies. But right now, Ulta and Urban are the earnings ideas that I want you to take away from this. So hope that helps. If you like these ideas, hit that like button. If you want a free course on how to find the next NVIDIA without gambling on startups, hit that subscribe. And if you like this talk or you want to chat about your portfolio, head over to stockscommunity.com. The link's in the description. 7-day trial for $25.
Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.